Stocks are known as equities. Unlike bonds, which are IOUs, a share of stock represents a piece of ownership in a corporation. Bondholders are creditors of a corporation, and their income is in the form of interest. Stockholders, however, because they are owners, share in the profits of the corporation, and the payments of the profits to the owners are known as dividends. There are three forms of business enterprise in the United States: the proprietorship, the partnership, and the corporation. The proprietorship and the partnership are identical except for the number of owners. A proprietorship only has one, a partnership has more than one. A corporation, however, is totally different from the other two. With the proprietorship and the partnership, the owners are personally liable for all of the debts of the firm. As a matter of fact, we can think of it in the following way. From the perspective of the government, Joe's Widget Company does not really exist. Now, to you and me, it exists because we can see the sign above the front door. However, from the perspective of the government, Joe's Widget Company is simply a name that Joe gives to a system of resources that he has organized to provide him with a profit. The income that is earned by Joe's Widget Company is not taxed as profits to the firm because in the eyes of the government, the firm doesn't even exist. Instead, it is taxed as personal income to Joe. If you slipped and fell in the warehouse of Joe's Widget Company, you wouldn't sue the company. It doesn't exist. Instead, you'd sue Joe. Now, with a partnership, each owner is responsible for the business debts incurred by one of the other partners. So if Joe wanted to finance the expansion of his operations by letting a partner, say Jim, buy in, he better know and trust Jim very well, because if Jim does something stupid, Joe might have to sell his house and car to pay for it. Corporations are different because they do exist in the eyes of government. In fact, the government considers a corporation a legal person. And because it's a legal person, the corporation, not the owners, is responsible for its own debts. The corporation's creditors cannot go after the personal wealth of the owners to pay its debts. And if you slipped and fell in the warehouse of Joe's Widget Corporation, you'd sue the corporation, not Joe. This legal concept is known as limited liability, and it's the feature of a corporation that makes it easier for it to raise money than either a proprietorship or a partnership. It's easier for corporations to raise money because the current owners don't have to trust or even know the other people that they are letting buy in. No owner is responsible for any of the business debts incurred by the other owners. The most that a particular owner of a corporation can lose is the amount of his investment. And this explains why, with few exceptions, the very large companies in America are corporations. The concept of limited liability is a benefit of incorporating and explains why larger firms tend to be corporations. But a drawback is the concept of double taxation. You'll recall that Joe's Widget Company, a sole proprietorship, did not have to pay taxes on its profits because the company, in the eyes of the government, doesn't exist. Those profits were taxed as personal income to Joe. However, a corporation, being a legal person, must pay taxes on its income. But when those taxes are distributed to the owners, that income is taxed as an income tax on dividends. So the corporate profits are twice taxed, first as profits to the corporation, then as personal income to the owners. Suppose some company wanted to grow larger. Where would it get the money to finance the new capital equipment, the factories, the delivery trucks, the computers, and all of the rest to do it? The proprietor could borrow money, or it could let some partners buy in. But if this didn't provide the sufficient amount of finance capital, it could, and I'm giving air quotes here, go public. By going public, the owner would convert the legal form of the company to a corporation and sell shares of stock to the public. This would, in essence, let the general public buy in. And the good news is that no shareholder would be responsible for the business failures and debts incurred by any of the other owners. Not all corporations go public. Some corporations are privately held and the general public cannot buy in. However, the largest corporations can only raise sufficient finance capital by selling shares to anybody and everybody. If a company wants to go public, it will require the services of an investment banking firm. Here are some investment banking firms that you've probably heard about. Investment banks don't take deposits, but they do provide a lot of financial services to firms, including underwriting their stock issuance. Suppose, for example, that Joe's Widget Company wanted to go public. Joe would incorporate his firm in accordance with the guidelines of the state in which the company was based, and the state would then permit Joe to issue a given number of shares. But Joe wouldn't sell the stock directly to the public. Instead, an investment bank would underwrite the stock issuance. That is, it would buy up all the shares that Joe wished to sell, and then the investment bank would sell them to the public. The purchase of the shares by the investment bank would be on the primary market. That's where brand new assets right straight off the showroom floor are purchased. And then the investment bank would sell the shares as an initial public offering, also known as an IPO, on the secondary market. And of course, as you know, this is where used or pre-owned assets are bought and sold. And from that point on, all of the shares of Joe's Widget Corporation would be traded on the secondary market. Joe's Widget Corporation would use the proceeds from the investment bank to expand, and the profits from the investment bank would be the difference between the cost of the underwriting the stock and the revenue it received from the IPO. So now thousands and thousands of investors own the stock of Joe's Widget Corporation. Each is eagerly awaiting the dividends. Now at this point, the price of the stock is determined by supply and demand, so the current owners are also hoping for the price of the stock to go up so they can make capital gains as well as the dividends. If Joe's Widget Corporation is profitable, it may use some of those profits to replace depreciated capital. It may use some of those profits to expand even further, or it may distribute some of the profits to the owners in the form of dividends. The higher the profits, the higher the dividends, and the more attractive the stock price would become to potential investors. If the company didn't do so well, the demand for the stock would go down, as would its price. If you wanted to buy some of this stock, you'd have to buy it from somebody who currently owns it and wants to sell it. And because the stock has been pre-owned, you'd have to buy it on the secondary market. But of the many, many shareholders of this corporation, who among them is currently willing to sell it at a price that you're willing to pay? This person would be so difficult to identify and so expensive and time-consuming to track down unless there was an organized secondary market. An organized secondary market provides one or more of the following services: a physical location for an auction, and there's our friend from the bond market again, intermediaries that keep an inventory so that in the absence of a counterparty, a trade can be consummated anyway, and electronic communications networks that keep track of bid and offer prices. Stock exchanges provide organized secondary markets for investors who want to buy and sell stocks. The New York Stock Exchange and the NASDAQ market are the two major stock exchanges in the U.S. There are several indices that help investors keep track of what's going on in the stock markets. The most often quoted is the Dow Jones Industrial Average, affectionately known as the Dow. This index is a weighted average of 30 very large corporations from various industries, all of which are listed on the New York Stock Exchange. Now, it's hardly the most indicative of what's going on in the stock market because its sample size is only 30. But it's the most familiar and the most often referenced because of tradition. The S&P 500 is more representative because its sample size, obviously, is 500 companies from both the New York Stock Exchange and the NASDAQ Exchange. S&P stands for Standard & Poor's, which is a financial services company that's best known, other than the stock market index, for its ratings of the riskiness of bonds. The NASDAQ Composite is a weighted average of all of the stocks listed on the NASDAQ exchange. That's over 3,000 companies. This market is dominated by smaller companies and high-tech corporations and is therefore more volatile than either the Dow or the S&P 500. The Russell 2000 index considers smaller companies and in general mutual fund companies, and it's particularly useful for giving investors insight into what is happening in the small and mid-cap segments of the market. Many, but not all corporations issue two kinds of stock, preferred and common. The most important, by far, is common stock. Preferred stock pays a fixed or quoted dividend, although it's not legally binding on the firm to pay it. The preferred shareholders are the second group to be paid after the bondholders. Preferred stock is a little more risky than bonds because the prices of shares are more volatile and there is some chance that the quoted dividends won't be paid at all. There's no chance of this for bondholders not being paid unless, of course, the corporation declares bankruptcy. Common stock is far more prevalent than preferred. The shareholders of common stock are the last to be paid, and therefore it could be after the company pays interest to the bondholders and dividends to the preferred stockholders, there might be nothing left to pay out. But if the company performs well, there could be a lot of profits left over and the dividends could be very high. Common stock, therefore, is the most risky, but the potential return is the highest of the three. History shows that from 1928 to 2013, common stocks have yielded a return of about 11.5%, whereas short-term T-bills have yielded 3.5%, and longer-term Treasury bonds have yielded about 5.2%. Preferred stock and corporate bonds fall somewhere between common stocks and U.S. Treasuries. But again, they're more risky, which begs the question, as an investor, which would you prefer? Would you rather eat or sleep? There is a second of this two-part video on stocks. Don't forget to watch it.